is Stephan Sturm. So the next speaker is Stephan Sturm. When to sell an asset, a distribution builder approach. And he's from the Worcester Polytechnic Institute. Stephan around? Oh, excuse. You're here. Hi, Stephan. Yeah, great. Welcome.
Thank you. Thank you. Okay, thank you very much. And I want to thank in particular all the faculty and staff from Tandon for organizing this conference. I think it was a big loss for us all, and I think it's a terrific opportunity to celebrate Peter's legacy and to see what we can build on what we have learned from him. So maybe some quick words. On my relationship with Peter. I don't know actually when I exactly saw him the first time. Of course, I learned from him in grad school. But the first time I really interacted with him was, I believe, 2015, and we were at this beautiful Lake Arrowhead in California, where UCLA has a nice conference center. And being fair, we had dinner together and were walking around the sea and had the possibility to chat. And he was at this time in particular interested by understanding volatility pumping. And from there on, we had an on-off Zoom relationship. But sometimes I came here to discuss many of the problems others already mentioned. And then directly before COVID, I was on my sabbatical, and Peter invited me to stay here for half a year. And I'm very glad for this. And I gave a talk here over. And after this talk, which was on the distribution builder, Peter and I went to the marketplace down, and he made a couple of comments. And actually all what I'm presenting is coming from these comments after my last talk. And this was basically what kept us over the difficult first weeks of COVID. I'm hunkered down in a very nice NYU apartment in Manhattan. Peter hunkered down in Brooklyn, getting some progress out on this. Okay, so what is this about? So the problem I want to discuss is a very old and classical one. Just think about, you have an asset and you want to find what is the best way, the best time to sell it. It's not an optimal execution problem like Jim is doing it. No, you have one single undivisible asset and it's completely liquid, and you want just to find what is the best way to sell it. Now, of course, this is a very classical problem, and so we are not the first to consider it. For instance, there is an approach which I would call a universal approach, which goes by the way to say, well, what is the best time to sell something? Well, of course, when the price is the highest, no? Well, the highest price is when it hits the running maximum. Well, unfortunately, we don't know when the highest price is the highest, since we cannot look in the future. This is not a stopping time. So the idea is, well, I'm looking for a stopping time which in a relative error expected way goes as close as possible to the maximum. This has been studied by Shiryayev, Xu, and Zhou in a very nicely titled paper, Partial Buy and Hold, by their conclusion, and then there's some refinement by Dutour and Pesquier. And I would think it a little bit, it's an optimal stopping analogon to what is Samuelson or Kelly criterion for utility. You don't try to get people's preferences or utilities, but you try to find a universal criterion. The second way to treat this problem is to treat it in a similar way as Roger treated his problem, meaning we want to maximize somehow the utility of the sale over all stopping times. There is a very nice paper from Tim Leung and Wang who summarize much of that in a similar spirit. Peterson and Pesquier who do it for mean variance. Vicky Henderson has done it in the context of cumulative prospect theory. So there's a lot there. Why we want to do something different? Well, we believe that the subjective approach is a good idea. We think it should matter what people's preferences are to determine when is the best time to sell. It should not something universal true. On the other hand side, and I'm very sorry, Roger, but I don't like utility for a couple of reasons. So we try to get away from this expected utility approach. Now, what one can do. The idea is to take up an idea which comes from Bill Sharp and which is called the distribution builder, and which Sharp has developed 20 years ago and 15 years ago. What is going on? Well, utility theory or related ideas like risk aversion coefficients are basically the mainstay in economics, finance, mathematical economics for such questions. So go back to Bernoulli, first half of 18th century. There are two issues with this usual idea of utility functions. The first one is that utility functions actually don't capture what people are doing. This is a mainstay of criticism of this line, which is known as behavioral finance. So there are a couple of Nobel Prizes on this, by Kahneman and others. And they say, okay, what is happening is actually utility functions are not so nice concave functions as mathematicians pretend to do, but at the end, they are somehow S-shaped, and actually it's not a probability, but there are distortions and so on. Actually, I'm fine with this criticism and I can ignore it, since this is how to understand what people are actually doing. If we try to give financial advice to people, we don't have to understand what people are doing, but we want to find the best way to do things. So this kind of criticism is a little bit moot for what we are doing. But the second line of criticism, I think, weighs much harder. It's just incredibly hard to find out what is a person's utility function, or even what is a person's risk coefficients. Well, there are a lot of tests, but they're all not very reliable, not very stable. So this is, I think, a pretty fundamental problem in implementing utility-based solutions in practice. And I think it's not a surprise that many practitioners are not very fond of utility functions. Now, what is an alternative? This goes back to the work by Sharp. He has a very nice book, 2006, and other works with Goldstein, who is actually a psychologist. And his reasoning is actually this: investors are notoriously bad in estimating the utility function, okay? So why worry about utility function? Try get more direct information what actually people want. And he's doing it in a optimal investment framework. So he says, well, if you want people helping to invest until their retirement, why don't let them choose directly which kind of distributions they want for the retirement, which they can afford with the current capital what they have. Or put it in his own words of this nice and much too underappreciated book, Investors and Market. He says, classical theory works in a way that you have budgets. You have a budget, how much you can afford. You have prices, meaning some model of asset price processes. You have preferences, usually a utility function or risk aversion coefficient or risk measure or whatever you like. And at the end of a process of doing some, let's say, utility maximization, you come out with a distribution for an optimal portfolio. He says, can we not completely invert this process? Well, we need still a budget and prices, but can we not actually treat the distribution as an input and actually treat the preferences as an output? If we even want them. For just trading, we don't need them. And the question is, how do we get the distribution as input? And this is exactly the tool he came up, which is called the distribution builder. And this is actually from Sharp's website. You have basically 100 small blocks like Tetris blocks, and you can move these Tetris blocks around. Well, if you move them higher, this means you want something more. If you move them lower, you want something less. Each of this block counts for 1 out of 100 scenarios, which you can get, so 1 of 100 potential futures. And then you have a back-end machine which runs the cost of this distribution, what it costs that you hedge this distribution, and it tells you how much of your budget it actually uses, or if it's even attainable by your budget. I will not go on how this builder works behind the scenes, since we are not speaking about optimal investment, but our question here is, and this was Peter's idea sitting over at the carbon market, can we use this idea of the distribution builder and use it for this different problem, for this asset selling problem? Can we use this distribution builder to determine the best time of selling an asset? And the method, and also this came already at this meeting from Peter, is it should be some connection to this Carr embedding problem. So what we are doing is we assume that the potential seller is allowed to specify the target distribution which they are interested at selling using this distribution builder. And then what we have to find is there actually a stopping time such that if we stop the asset price process at the stopping time, that we get exactly the distribution which the customer wants or the seller wants. So this is what we call an attainable distribution. If we can find a stopping time, that the process X stopped at the time as exactly this distribution F. But actually, we might actually want a little bit more. Since like if we speak about hedging, we actually always consider in more general setting super hedging. Of course, if somebody gets me a distribution and says, can you hedge this distribution? And I tell them, no, I cannot sell exactly this distribution, but I can hedge a distribution which is strictly better than your distribution, then this guy should be happy, no? So we are generalizing the idea of attainability by super attainability, that we say a distribution is super attainable if we can find a stopping time that the process stopped at the stopping time is always better than F, and better, I mean now first order stochastic dominance. And of course, very related questions are, first of all, this helps us only to determine which distributions can be attained or super attained. Question is, are some of them optimal? In which sense? And the other question is, of course, if I want to implement this practically, is this something where we can find the stopping time in a constructive way, just giving the price process? Or do we have to solve a 17-dimensional BSDE and get then a completely obscure answer? And the idea, as I said, which Peter already had at this time, this should have to do something with the so-called scorehard embedding problem. The scorehard embedding problem solves this question for Brownian motion. Can we find a stopping time set if I stop the Brownian motion at the stopping time, I get a given distribution F? And what we will rely on is generalizations to these classical versions for diffusion processes, starting back by work of Azema and Yor, and then Granditz and Faulkner, Peterson and Pesquet, and most recently Cox and Hobson. Now, let's go into action, and I will not go into the full diffusion theory. I don't want to hold up with technicalities. I want just to study the reference point of geometric Brownian motion. I think this is where we can easily understand what's going on. If you're interested more in the technical diffusion stuff, we can have questions later or discuss it outside. So what we think about this, we have now an asset price process which follows a geometric Brownian motion. And let's assume we have some discounting rate R. It's not necessarily an interest rate, since we're not doing any hedging here. All we are stopping at some point to sell the asset. So we can just assume this is a purely subjective discount rate. It can be an interest rate, a risk-free rate, whatever you want, but it doesn't have to, since we're not hedging. So we know very easily, since a discounted asset price process also follows a geometric Brownian motion just without a drift. Okay, and I'm coming to the main theorem, and the main theorem says, if actually this modified drift or excess returns, or however you call it, is larger or equal than variance over 2, volatility squared over 2, then actually any distribution is super attainable. Whatever distribution you give me in this market model, you can do better than that distribution. However, this is no longer the case if the excess returns are smaller than sigma squared over 2. Then we have a precise condition when a distribution is super attainable. And this is a kind of moment condition. If the eighth moment of this distribution, well, scaled with the initial value of our distribution, is smaller or equal to 1, then we can do it, otherwise not. And A is just a constant where the whole market parameters come in. Now, we can, this case, a little bit subdivided into 2 more cases. And the one is if our excess returns are still positive, then in particular, there exist some super attainable distributions where the mean from what we can get is actually larger than the original value of the distribution. Whereas if the interest rate is higher than the drift of the assets, then we will always get something what has mean smaller. So let's try to translate this into our optimal asset problem. Last case is very easy. It tells you, well, you can only get some distributions which have this definition, but all distributions you can get have actually a mean smaller than what your initial value was. Well, if I can only get things which are worse by mean and have some variance, well, then I don't wait. I just tell directly this is the best what I can get. Similarly, the last case, as the first case tells me, well, you might think about selling the asset, but actually it's a stupid idea to sell the asset. But whatever the point is that when you can sell, you can still do better. So don't sell. And what is actually the interesting case is the case in between, when we somehow have excess return higher than the discount rate, but not too high, then we can get actually something which is better than selling immediately, but we cannot get everything. So this is a really interesting case. Now, what we can say? Well, the question is, we want, of course, distributions which in a certain way optimal, and optimal in this way means that my inequality constraint, which I have, does not hold only as an inequality, but holds with equality. Since basically otherwise, if there's a strict inequality, I can find some additional point mass on the distribution on a higher point so that I can do better. So optimal we are if this thing here holds with equality. And we know, of course, not optimal distributions are attainable. And of course, not all attainable distributions are optimal. But each optimal distribution defined in this way, we can actually attain. Okay, how we do this practically? I promised you not only to give an abstract solution, but something what is actually practically implementable. This relies exactly on the Assay-Major solution to this cohort problem. And it's pretty technical, so let's just focus on the idea. This is just some complicated function. The idea for the stopping time is we look on the running minimum and the actual process and some deterministic function, and we stop the first time the running minimum gets smaller than this function of the process. Or you could also see it differently if the two-dimensional process of running minimum and actual price process is hitting a certain region defined by this function. Let's do it more graphical. I think this is a little bit more intuitive. The blue is your price process. This is your asset process, which of the asset what you want to sell. The red process is just the running minimum. So every time we are going to a new level with the blue process, the red process is following down, but it is never following up. And the green line is nothing else than a deterministic function of the blue process. And I said the first time the red line hits the green line, we are selling, meaning we don't have any change in value of the asset anymore. Or we can also think it in this two-dimensional sense, plotting asset value against running minimum, meaning if the running minimum is not going down, we are going just left, right. If the running minimum is going down, we run here at 45 degrees. And the first time we hit this now completely deterministic function, which is happening at this point, we sell and execute the asset sell. And by the way, you see this is happening always on an uptick after hitting some minimum. So basically, when after some minimum you're going reasonably enough up, then you will hit the barrier and you will sell. Okay, to finish, let me show how we can make this even more accessible if we don't think about trying to get all distributions, but if we specify a parameterized family of distributions. Say you're interested to sell at some log normal distribution or gamma distribution or Pareto distribution or a Weibull or whatever. And then the question is, of course, which parameter constellation between mean and variance or dispersion are those which are possible and which are optimal. And it turns out, if we ask the question in this way, we become actually a solution which is a little bit in the type of Markowitz theory or the efficient frontier, meaning we will have a trade-off between mean and variance, between risk and return for optimal selling. Again, look on the pictures. Let's just fix the left at top. This is for log normal random log normal target distribution. These are just 3 different values of A, so just pick one of them. And this on the x-axis is the standard deviation, and on the y-axis is just the mean. And this is basically our efficient frontier. This is the best thing what we can pick. Hence, I can get a higher mean if I want, but the price of getting a higher mean is that I have to allow for a higher standard deviation. Exactly the same thing what is happening in Markowitz. The shape looks very different, and the thing is, it depends also on the distribution. If you can go arbitrarily high, you might guess that in the log normal and in the gamma case, you can indeed, by increasing the standard deviation, move the mean arbitrarily large. Whereas in the Pareto case, you can increase the standard deviation to improve the mean, but there is an absolute bound beyond which you cannot move the mean up. Okay. And you can get these things all in pretty much closed form. Here, just as an example, that you can see it for the log normal target distribution. We have an exact definition when such a distribution is attainable, and we can give an explicit representation of the barrier function for this as a major stopping time, and we can do similar things for the other distributions. So I think this is all what I wanted to say. To conclude, we can use this idea of a distribution builder, which was developed by Sharp for optimal investing, and can apply it successfully to this optimal timing of a sale question. The analysis is very much relying on this cohort embedding problem and its offsprings. And we get results actually when we check it and when we compare it with the other results, which very much agree with economic intuition and which make sense. So I want not only thank the audience for listening, but I want to thank Peter for all the support and advice he gave. But I think foremost for all the fun we had exploring many ideas among this, and always being ready to explore things which are very much outside of the mainstream, and just thinking about what is exciting and what is beautiful. So thank you.
I think this theme of sharing ideas with Peter and discussing ideas with Peter is something that we can all agree to. And we all remember Peter for. So thank you for all your thoughts. Any questions from anyone in the audience? Yes.
Thank you. Yeah, the more I see this presentation, I've seen previous versions, and the more I like. Could we go back actually to slide 17, which is the, as I recall it, the Brownian motion, geometric Brownian motion case? Yeah, so this is, okay, geometric Brownian motion. So I just a sort of observation, trying to put numbers in. If I divide both sides by sigma, I get to the left-hand side the Sharpe ratio, and I get half of the volatility to the right-hand side.
Yeah.
And if I put some numbers in, let's say volatility of S&P is long-term 20%, so I get 10% Sharpe ratio, which is not considered typically as an expected Sharpe ratio as a particularly, attractive or high number. And so in some sense, it sounds like for the geometric Brownian, if we believe in geometric Brownian motion, then theorem 1 is the one that is going to happen in practice, or be the most relevant for a practice. And so as a result, I'm sort of wondering if that makes a case that geometric Brownian motion should not be really, I mean, I guess it goes against geometric Brownian motion as a relevant model, because presumably, there is more to it than just saying, okay, well, Sharpe ratio of 10% is the only relevant case. So I'm thinking that if we don't have geometric Brownian motion, the theorem would be more complex, perhaps, than this practical simplification here that I'm talking about.
So it could be the case. So let me just compare this to the other theory, which we have seen also for black holes, which is work by Shiryayev, Xu, and Zhou, who actually come to the conclusion. So basically, they have a similar conclusion, only that their threshold is not sigma squared over 2, but sigma squared. And they say if you're above, you always hold. If you are below, you always sell. Basically, what they don't have is this middle case. However, if you rephrase the infimum problem in a supremum problem of the inverse, which Dutoit and Pesquet have done, you get basically exactly the same bounds as we have here. So it might be indeed something what is relatively intrinsic to the geometric Brownian motion, since two very different methodologies come to very similar results on what is good on buying and selling.
And that discards the geometric Brownian motion maybe as a good model.
I have a question back here.
Yeah.
Can you see me? Oh, hi. On the same slide, I guess it was 17, but yeah. Can you explain to me what seems to me a paradox, which is this is a one person model. Okay, you're modeling you.
Yeah.
But presumably you exist in a quasi equilibrium. So this is completely unstable. If you have a situation where you would sell immediately, correct? That would mean that the asset would have expectation of always declining, but you would not have a counterparty in that case. So in other words, this is dependent, this embedded distribution seems dependent on other people with totally different distributional, distributions, because no one would buy from you if they were dependent on the same parameter space.
First of all, this is definitively correct. People have different distributions as people have different utilities, different risk aversion coefficients. And we are indeed not at all speaking about equilibrium. I would really think about something like you have a car and you want to sell the car. What is the best time to sell the car? You will not make a market impact when you're selling a car. There are enough cars around. You cannot divide the car into small parts and sell the tires tomorrow and the windshield in 2 days. So you are doing it entirely and you don't think very much about equilibrium or price impact, since you're small enough so you don't have anything. And well, anyway, you are selling it at once. so you don't care what is happening after you sell with the price process. Thank you.
Hi, thank you very much for your talk. I think this is very interesting. If you could go to the slide of the shapes of the frontiers, like I wonder if like you have like sort of explored like why, like if there is a connection between the shape of the distribution or some property of distribution and whether the frontier becomes convex or concave.
Ooh. No, I have no idea. I can tell you I have calculated a couple of problems explicitly. This with this redistribution and I think rival, where you have explicit forms and you can look on it, but I don't see a direct relationship to convexity or concavity here. I can tell you this is for the Brownian motion case. If you go to general diffusions, actually things look quite a little bit difficult and cases are not so straightforward, but no, I have
like,
no idea.
Be curious to see like if there is some, just as advice, like to understand why sometimes it's concave and sometimes it's convex, because this is at the end of the day a relationship between risk and return, and it's relevant, I think.
I will think about it, but by now I cannot give you any affirmative answer.
Thank you so much.
You're welcome.
I know we have overrun by a couple of minutes, so I will ask you to follow up with any further questions afterwards in the interest of time. Next speaker is joined